are in listen-only mode.
Good evening, everyone. Welcome to Admiral Markets. Thank you for joining us in this live webinar where we take a look at tools and indicators together. So Nanette and I will be discussing and sharing what we think is important about these two important things, because tools and indicators are very often used by Forex traders, and we want to shed a light, our vision on how to use them the best way. Before we do that, though, be aware that this webinar is intended for a global audience. It may not be suitable for everyone. To find out if it is and more information on details and conditions, please visit the link mentioned here at admiralmarketsglobal.com. Select your country of residence and contact an appropriate entity. Also, please be aware that trading foreign exchange is considered high risk and may not be suitable for all investors and traders. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer. So, hello Jen, hello everyone, welcome. Once again, this is hosted by Admiral Markets. And for the last time, I guess, because it is the 30th of April, this slide still showing the special deposit bonus available for traders with the initial deposit done. A percentage bonus is potentially there as margin or even as a bonus, depending on the volume after 6 months. But take a look at the conditions and details through this link. It's a bit running out of time, but perhaps you can still make it. Alrighty, tools and indicators. They're great stuff, right? Because they give us confidence, they give us trading opportunities. Some of us don't use tools and indicators at all. Some of us only trade price action and perhaps use support and resistance, tops and bottoms as well, but basically trade a naked chart. Some of us use a ton of tools and indicators and we wouldn't even see the chart. So obviously that latter one, when you do too much, is not good. But yes, you don't even need the tool and indicator to trade, but in that regard, perhaps you need a bit more experience, perhaps you need a bit more knowledge just to trade naked. It's definitely possible. Personally, I don't have anything against looking at a naked chart, but occasionally, or regularly I should say, I do add a tool or indicator here and there just to give a bit more confidence, a bit more idea what's going on in the chart, to get more information basically. And as long as that goes well, and if you can handle that, and it doesn't become too much of an overload, too many things on the chart, then that's perfectly fine, and they will help the trading in fact. So in this webinar, I want to discuss about how we can use tools and indicators to make and get that balance where we're using them effectively. That's my mission here today. And then after I finish, then it's going to take over and share his opinion. First of all, though, in my opinion, to make clear, the tool is drawn by the trader. An indicator is something that is basically already on the chart, and we insert it and it's there. The tool is drawn and often has to be updated or deleted because it's a manual thing we do. An indicator can be inserted and we don't have to take care of it. It will be there. It will be automatically adjusted. The moving average will be automatically calculated. As soon as the new bar is there, the oscillator will be newly calculated. The pivot point will be newly calculated. So that's all done by the indicator. So the indicator doesn't require any work from us. The tool requires adjustments and our discretion to place it where we want to place it. So an example of a tool is Fibonacci and trend lines. An example of an indicator is a pivot point or a moving average. So why even use tools and indicators? Well, it's confidence in the setup. When we start out our Forex career and Forex trading, obviously the confidence might be high at the beginning, but it can never stay that high because of the fact that we don't have the experience and knowledge. So you're going to have a downside swing in the confidence, and basically we try to compensate that lack of experience and confidence by getting confirmations and confluences and confirmations, right? So actually there are 3 C's: confidence, confluence, and confirmation. That in itself is nothing wrong, but the problem is if you get too much of that, then you're bumping into some problems. Trying to boost the confidence in the setup is a natural process at the beginning and throughout your trading career to get to a point where you have that confidence to take setups and also not to take too many, a well-balanced psychology. It's just a part of the process. Tools and indicators will help with that process, I think, personally. And as long as we don't exaggerate with them. Tools and indicators will give us more methods of analysis. They'll give us confluence in setups, right? And perhaps, if done properly, better entries and exits. As long as we use tools and indicators that are part of a wider system, a wider trading plan, then that's fine. If we start our focus on tools and indicators and then kind of like make the trading plan after that, it's kind of the turned upside down. We first want to think about why would our trading plan work out in the market? What is our edge? And then try to see what tools and indicators would fit best in that plan instead of first looking at the tools and indicators and then thinking, okay, what kind of system goes around that? Right? That's, I think, the best way to build a trading plan if you want to do it yourself. So there are some good things that I think make sense for tools and indicators, why they're useful. Confluence, more analysis, confidence, and making a good plan. The tool and indicator, basically, they help with 3 things. Why should we have them? And first of all, well, they help with these 3 things. They help with identifying the market structure, in my opinion. They identify support and resistance and patterns. So it's all about market structure, support and resistance, and patterns. Because if you look at the Forex market, right, or any market perhaps, if my drawing tool will work, it seems to be doing a bit funny somehow. Okay, well, anyhow, if you look at the Forex market and you look at the chart, and you look at price, for instance, here you see price going down, up, like this, and you see consolidation, and you see upside like that, and like that. And what can we conclude? Well, price is bouncing and using and breaking support and resistances all the time along the way. It's just a horrible drawing, sorry about that, but and it's trending at times and ranging at other times or reversing at other times. And within those market structures, and when it's using the support and resistances, we can get rid of that, is making patterns. So if we know these 3 things, or if we can analyze these 3 things, I think with the use of tools and indicators or without them, but for the moment, of course, we're focusing on with them, then I think we can become better analysts and better traders. But what happens if we exaggerate with that? Of course, then there's that danger that we cross the line of a clear, good, simple, logical trading plan, and we get closer and closer to something vague and not understandable and not usable and just not clear enough. And a chart like this, of course, although very exaggerated, would obviously mean that we have no clue what to do. No idea. There's a paralysis of analysis. We've got too many tools and indicators, and a lot of criticism, of course, from price action traders at traders that use tools and indicators is based on this. Too complicated, not clear enough. And it is true, this is not good, right? This is not going to help us trade. This doesn't give us an idea what we should do at what point and why and when and how and etc. This is chaos. And this is something we have to avoid. As long as we avoid that and remain, avoid the paralysis of analysis, tools and indicators are useful elements if done properly. So charts, paralysis of analysis, the charts will be full and crowded. The role of the indicator is not clear. Why do we have it? How do we use it? Why would we use it? It doesn't make sense. It's just confusing. So some solutions. and these are general things, and I'm going to dive into more details after this. Keep trading simple. Simple, simple, simple. Simplicity is core message here. It's easy to get kind of a mushroom of ideas and a mushroom of details and a mushroom of tools and indicators. And although sometimes it's worth, of course, definitely going into some detail, you want to be careful with the complexity. And also careful with seeking and searching for perfection when using tools and indicators. Learn from other traders, so we want to match, and I want to say actually match the strategy with psychology. It's great that certain strategies work well for other people, but you need to also make sure that whatever strategy you use, it suits you. It's adjustable perhaps to more of your own characteristics or psychology, so that there's a sync there. Good strategies have that built in them. They have rules and guidelines, but they allow traders to a certain degree adjust it to make it their own kind of strategy, to custom adjust it a bit, right? And then last but not least, know the role of the indicators and tools. If we know why we have the tools there and for what reason, that will help significantly too. So these three things, although quite general, right, are the core kind of ideas to help with finding that balance, striking that balance that we have useful tools and indicators but don't get overcrowded. In my opinion, tools and indicators are very useful because if we are starting out, there's a bias problem often enough. If you're a more experienced trader, the bias problem is not there or less important. A experienced trader can look at the chart and will factor in a lot of things at the same time. They will think about time factor, time of day, the news events, historical levels, bigger time frame, supportive resistances, intraday momentum, and factor in whether there's enough space, whether there's a trade that could be worth trading now. And they could have a bias that a short at this moment, although against the trend, makes sense. And they'll be profitable with this kind of discretionary analysis, right? Kind of with not even using any tools or indicators. The problem is that if you don't have that experience, you might have many ideas, you might think what the euro dollar should do, but the problem is that the trader doesn't have the experience or the knowledge enough to do that consistently enough. You might be, I mean, that trader might be right a few times, but often enough the thinking almost gets in the way. The trader thinks that should happen. The trader thinks that must happen. The trader wants that to happen. So you get a lot of emotions in that, and the bias kind of creates an almost annoying emotion, and that could be a problem because we think that should happen, so we get almost emotionally attached to that idea, and if it doesn't work out, then we almost get mad at the market, want to revenge trade, and it leads to almost all these bad things. An experienced trader realizes that it's a trade setup, and it's only one trade setup, and it can go well or not, and it doesn't reflect anything about their skill level. If someone with that experience does that, it will reflect badly on their own confidence and their selves. So that's kind of the problem. So when you think that something must happen, think again. Nothing has to happen, right? We, especially at the beginning, want to lower the bias. We want to remove our ego. We want to remove the bias out of the equation. So we want to use indicators, I think, and tools to identify decision spots on the chart so that we actually say, okay, price has to reach this resistance, or it has to break that level, or it has to reach this support before I'm trading it. Because otherwise, traders are tempted to trade it right now. They see price moving, they get all antsy, and they're all excited, and I need to trade it right now, and they jump into trade. By having a decision spot saying, okay, price has to get, pull back to the 50 fib. It has to do something. Let's, for instance, say that price is in a wedge like this. Okay, so I want price to get back to the bottom here before trading it, right? Or I need it to back at the top, or I need it at the 50 fib. It helps us determine when and where we're interested in a currency pair so that we're not just chasing the market at every spot. The advantage of that when we have decision spots on the chart is that we're not predicting but reacting to price. What we want to do is make a reaction plan, a trade plan, and let price do whatever it wants to do. Price is neutral, we're neutral, and we're just responding to whatever it wants to do. We don't want to impose kind of our opinion or our ideas on it. The previous slide is here. Keeping trading simple. I think that's what you mean, Justinus? Slides. I'm not sure which roll slides. Let me think again. Roll slides. Not sure which screenshot now you're actually mean. Let me know which one. I'm not sure actually which one that is. All right? So the advantage of decision spots, it removes kind of that bias. It's difficult to remove the entire bias. We all have kind of the idea that the euro dollar could go up, and we might have very good reasons to think the euro dollar would go up. We might have very good analysis about that. But still, it's, to a certain degree, we want to have the decision spot that we say, okay, when price gets here, that's when we want to trade it, so that we kind of let our own analysis be proved. Obviously, if your analysis is time in and time out often right, then the bias that you might have is probably perfectly fine, to be honest. But if you see my point, you want to be careful at the beginning. You want first to let your analysis be proved correctly to yourself. That's the point. So that we remove bias, especially at the beginning. And then as we continue with our career, it will be maybe less important. So the idea is basically that we don't get emotionally involved and let the market and price decide. We set up our plan and we follow it. So we set up, that's the thinking part. When we set up the plan, when we say, okay, price has to break this resistance, or price has to bounce or move up to this resistance, that's the thinking part. But when it happens, then we have to implement it. So we need to be the general at one time and also the soldier, right? We need to be the general in setting up the plan as the soldier when executing the plan. Because if we start to be the general when executing the plan, we're going to think too much and overthink, and then we are not going to be executing properly because we're going to be self-doubting and second-guessing too much. So think before and execute after. And that's basically the roadmap or the trading plan that we will have for that day. And in that regard, once we have the trading plan ready, we're roadmap readers. We look at the chart same as a roadmap. Price is going from A to B, and we're also thinking, how can we get there as fast as possible? Right? We don't want to second-guess and read too much into it. We're just trying to simply read the charts. So let's take a look at a live chart. Traders, I think it's best to look for triggers at decision spots. That also depends on your experience. I like triggers personally. It, for instance, would give let's say, for instance, that there is a resistance level. Well, let's take actually an example here on the chart. That's better. Alrighty. Let's take a look. Let's take an example of the pound dollar, perhaps. It was an example that was used in the trading room on Tuesday. In the trading room on Tuesday, I said I'm looking for a buy from the 50 fib at 151.80, right here where I have the cursor. And it went up to the 153.50 for 170 pips, and actually went up to 155 after that, right? That was a good trade, a winning trade. So let's take a look at that. So when we were looking at price in the trading room, price was about here, where I have the cursor now. And that was not a spot I wanted to trade it. I wanted it to retrace. So what was my decision spot? My decision spot was basically a break of this top or a pullback to the 50 fib. When price was in between it, it was a no trade zone for me. It's not to say that it wasn't possible to take a trade in here. I'm not saying that it was not necessarily a bad idea. But for me, I didn't think it was optimal. I thought it was better to wait for a retracement or a break so that we have a optimal timing of entry and a better price potential as well. Obviously, if you took it somewhere in here, right near the resistance, it is 60 pips worse than the pullback. It could be better than the breakout, but at least the breakout, perhaps you can tighten up the stop loss, like the example I had in the trading room on Wednesday with the pound yen, as you're trading momentum. So basically, if a trader would have taken a trade here and put the stop loss below this fractal, and let me move up the level right here, then that would have been a loss. That could happen. You have a bias to the upside. You take the trade immediately, put the tight stop loss, and you get knocked out. That happens to probably all of us. And I hope that it makes sense what I'm saying here, that you can avoid that by by setting up setting up decision spots and saying, okay, I'm not trading it unless it does that or goes there, and you remove the nervousness from your trading, and you kick in and create that patience before trading it, even though your bias is to the upside with the pound dollar. Right? Now, if your bias is downside, right, you might be in trouble. But our bias was upside because we identified the trend to the upside. Now, I was talking actually about triggers. In this case, the trigger, right, was actually a pending order. So I didn't use a trigger, but one could use, for instance, a lower time frame and say, okay, this is a bullish candle at the bounce off the 50 fib, take the entry here and put the stop loss below it. It would be a confirmation, a price action confirmation at that. Not everyone is a fan of confirmation, and to be honest, in this case, you can clearly see that even the confirmation is great. In some cases, the confirmation could be a very bad price. But if you use a lower time frame, most of the time it should be okay. There was a news event, very true. But those things happen. I would actually like that we don't have news events, but sometimes news events are kind of the catalyst that give the retracement. But what is very interesting is that despite the big bearish momentum during news event, the 50 fib slash 61.8 zone is very well respected and used up. So my bias, in my opinion, it is a clear reaction. It is a clear market involvement that price the market definitely knew that this was a retracement that was worth buying for the long term and bounced off that level. And the news event created that, indeed, but for me that's not a problem. That happens. Obviously, if you don't like trading news events, then you want to wait for confirmation candle and you trade it 50 minutes later and you don't take the pending, right? Sometimes news events are going to be a headache and they're going to create a spike and you get a loss. Definitely, right? But a trade like this will compensate a lot because of the bigger win. The pullback here, in my opinion, was a classical setup, was I would say a very nice setup. Was for me little doubt to take those trades on the euro dollar, pound dollar, and Aussie at that time. And it was just a nice trend. It had a lot of confluence, a lot of broken resistances and support. So the news event was there, but I think otherwise the total environment was ready for that, if you get my point. So let's see. Any other questions? You could, let's see, if Greg is asking, I think about the pound dollar. It really depends how you want to trade it. First of all, I use both pending and market orders. A pending order I use if I feel more confident about the setup, personally. And if I have more doubts about the setup, I will wait for price action confirmation. If the fib is small, like this, an hourly confirmation could be too late or on the later side. If we wait for a 1 hour candle here, right, it's still some good real estate left, good space left, but less. So zooming into a lower time frame might solve that. In this case, I had a pending order because I like the setup enough. You can take market orders too. For instance, if you don't want a pending order, for instance, let's say take a look at this pound dollar. You don't like the pending order, but you see price fall and you see a bit of hesitation, perhaps, I don't know, on the 5-minute chart. Let me find it. Not really that much, but okay. Let's say you don't take the pending order, but you see price fall and you see a few dojis, and then you decide to take the market order then. Right? That's another way of doing it. Just that initial pause. The idea behind it is that you let the news event pass, and you see that price is not at least falling like a crazy stone through that level, right, with a few dojis there. That would be an alternative to taking the pending order as a market order after a few of those candles. Or a more substantial one would be a 15-minute candle one, or an hourly, right? The more confirmation, sometimes the worse price, though. I personally had pending orders at that time, so I didn't look indeed for the confirmation. True. And it was a buy limit. A buy limit because the price was falling down to the 50. But with the Aussie, it was different at that time on Tuesday, right? Because at that point, there was a breakout and price was above the high and the resistance, and I took an entry right here and we got this rally, if I remember correctly, 28th. Yeah, it should be here. So it was a market order, and basically everything was already in play. Everything was already, in my opinion, ready for that trade. The pound yen on Wednesday was another market order and not a pending order. There, everything was ready too, I thought, although I definitely thought about it for a while. Where was it? I don't remember. Doesn't seem. Here. No. Sorry about that. I will find it soon enough. It was yesterday, the 29th in the morning. So that must have been here. I don't recognize it somehow. That's weird. Normally I do. Here. Sorry, here. Right here. We had to burst up, and then we started to, we had this bullish candle. This bullish candle is where I took it, on this bullish candle. Right? So we got a small rally after that, 60 pips, well, for the pound yen small. With the trail stop would have been a 40 win-ish, 37 win-ish. If one had a bit looser trail stop, then you could have reached the 184 target that we had in mind. But only after that we trace the bull flag, right? Anyhow, the idea is that here everything was set up, so a market order was taken, and a pending order was not needed. Alrighty. Oh, you're not seeing the screen? That's weird. So, yeah, the news events are going to be a headache sometimes. I mean, they're definitely going to cause losses or get worse prices. Sometimes the news event could be totally against your bias and indeed cause headache. Sometimes the news event is against your bias but still respects the fib. It's always indeed to a certain degree an unknown factor, but sometimes it works, sometimes it doesn't. It all depends on the structure and the news event itself, I would say, and the combination of that. And sometimes not easy to calculate, so you got to find a balance there. The entry model. So I use the entry model is the Toftim model. And the exits, I use time, trill, and divergence. Oh, I'm really running out of time. Not even looking at the time. I see that it's already 6:31. So I'll have to do this fast. Sorry about that. Entry. So when I use tools and indicators, I look at trend, I look at decision spot, I use it filters, trigger, and entry method. The trend, I try to get a feeling for the structure of the market. Decision spot, I use trend lines, fibs, support and resistance, moving averages. Filters, mostly support and resistance, or divergence, I forgot it. Sorry. Trigger, price action candlesticks. Entry, price action candlesticks, fractals, and high and lows. So I specifically use moving averages, tools and indicators for defining the market structure to see in what area I would like to trade it, and then is there anything that I don't want to trade it, right? So market structure, where would I want to trade it and why would I not want to trade it? If the pair is still interesting, then I can look for triggers at those decision spots perhaps, or entries right at those decision spots, depending on the confidence and my analysis. Triggers and entries are more done with price action, whereas the tools and indicators are more solving 1, 2, and 3, as you can see, in my opinion. This is not too important, but it's like a trend is initial interest, an opportunity is a potential trade setup, and a confirmed trade setup, and a potential trade, and an actual trade. It's not so important. Exits. For swing trades, I use trill stop losses plus soft TPs and divergence. For intraday, I use time factor and divergence and more hard TPs and trails too. And trails, I use fractals and lows and highs, candles. And divergence, I look at awesome oscillators and from time factor too. If, for instance, this is retracing, then you know that the momentum is kind of dying out, and you got the bull flag indeed, right? So if it's increasing, there's momentum. All right, that's my part. I'm going to hand it over to Ned now.
Thank you, Chris. Good presentation. Yeah, okay, but Chris, I think that Justinius is asking for you to roll your slides from the beginning. So you can do it so I can continue afterwards.
Okay, so let me,
Seems that Chris is already, okay.
Yeah. There's some delay. I already hit that change presenter like 30 seconds ago, so. Okay, I will otherwise, okay, cool.
Here it got.
All right, so tell me, Justinus, which one?
So yeah, you can roll your slides. So Justinius.
Or Justinus, maybe send me an email and I'll just send you the slide that you have interest in. Maybe that's the best. Let's do that. I'll send you I'll just post my email address. Okay, I'll hand it over now to T.
Okay, thank you. So we can continue where Chris stopped. So basically, Chris has explained how he makes entries, how he uses the indicators. I will do a little bit different presentation. I will concentrate on giving you some statistics for using various indicators so you can benefit from the statistics which were conducted some 3 or 4 years ago. Before I begin with that, I will tell you a quick classification of indicators. So you probably know what I think of indicators, and I think they can be good. Most of the time I am putting my force, of course, on price action, but nevertheless there are good indicators out in the forex market and really good indicators which can help you definitely to make money. So I usually think, and my opinion is basically that we should always look for as simple system as it can be. So without clustering a lot of indicators, because that can really give us the trouble, because usually if that happens we would be in a losing side, because there are no combination of indicators which can guarantee you good wins, and most of those combinations do not work when market is ranging, when market is range bound. So basically what you need to do is you need to try to find a system which is accurate, because most of the time we are losing because of the psychology, not because of the system. So the thing is, there are, first of all, and the most maybe used one, and maybe one of my favorite dynamic support resistance indicators are moving averages. That is definitely the truth, because moving averages act as dynamic and great support resistance levels. So we can classify moving averages as simple SMA, exponential EMA, and smoothed MA. So the thing is, when we try to deal with moving averages, we do not want to take any crossover trades, because crossover trades usually work in trending conditions, but when there is a ranging market, we can only get the DNA spiral, and the DNA spiral looks something like this. So basically we would be having a lot of false signals which would be very, very hard to figure out. So we want to concentrate, if we take a look at moving averages, we just want to concentrate basically on crossovers for a trend confirmation, not for entries. But nevertheless, moving averages are very, very useful as dynamic support and resistance levels, and the most of all, I definitely prefer exponential moving averages out of all moving averages. We also can have Bollinger Bands, which also serve as dynamic support resistance levels, and we can use basically static support resistance levels such as Camarilla or pivot points. So you need to make a difference between dynamic support and resistance indicators and what I said, static support resistance levels such as Camarilla or pivot point. Okay. Now this is how good looking chart can look like. So basically this is what I took a shot at, and what I see is that this system, particularly, I didn't test it, but this chart looks fine, because you have candles which are very easy to spot. You have only 2 additional indicators and 1 arrow indicator, which is probably one of the filters for entry. So when we take a look at this chart, this is good looking chart because it's not clustered, it's easy to read, and it only uses few filters. This is also a good looking chart, and I have chosen it to be completely different from the previous, and this I need to say good looking chart has only couple of indicators. It uses dynamic support and resistance levels. Okay, these are the bands which use dynamic support and resistance levels. This is a Hull EMA. We will talk about maybe this system in one of our next classes. This is one filter, and there is only one filter which can serve also as an entry. It's stochastic with a slope, with a color-coded slope. So this is also pretty much straightforward and good-looking system. It doesn't use many indicators. It uses balanced approach. And after I show you good and bad looking, I will tell you, in my opinion, what balanced approach is. This is also, of course, good looking system. This is, I just put it on Euro M5, but this is basically my range bar system, which I have been presenting you. And basically this is also, I can say, a good looking system because it only uses EMAs for trend confirmation. It uses pivots for setting up targets and stops, and it uses only MACD for playing entries. So basically, this is all how good-looking systems look like, okay? Now, bad-looking systems are, this is bad-looking systems, and back in time, while I was managing, I was basically managing Euro-dollar trade on Forex Factory website. I was looking at this kind of systems constantly. These were always bad systems to me because the number of indicators is pretty much, it just makes that your eyes burn. And it makes really my eyes burn while I'm looking at this at the moment. So, and there are really a lot of systems out there which can show you this kind of picture. So if you ever encounter one of those systems, guys, try to run away from it, because when you have a lot of indicators clustered at system, I can never agree that it can be a good system. Maybe for someone, but I just hate to look at this kind of things. And I think that clustering charts with a lot of indicators can just give you bad trades and can put you in a big drawdown. So I'm really not a fan of looking at these kind of systems over the internet. This maybe looks a little bit better, but it is through nature, this is not a good system. I just cannot say because it's a good system because it uses triple moving average, basically 3 moving averages. It uses stochastic, it uses MACD, and it uses Elder Force indicator. Now, what does this mean, basically, if we translate it to trading terms? I have tried to look at this system, and I have tried to figure out what the creator of this system basically thinks, and what he thinks. How can he possibly trade this system? I'm not sure that the creator of this system was actually thinking about making traders profitable. I actually think that he just wanted to make money with selling this system, because I don't see any logic in this. Force indicator is an absolute, I can say this is like a add-on to this system which serves no purpose at all. This can be safely deleted. Also, why would it choose to trade with 3 moving averages? This is too much, because these moving averages are so close to each other. So when we have ranging market, there is no filter from all of these filters down there which can possibly be filtering these trades. Stochastics is usually overbought, oversold indicators which can give us also the entries, but it's it's a total nonsense looking at this, because MACD also is an old one, and it doesn't give you any cue for a potential trade. I just cannot find any logic behind the system, let alone this Elder Force index down there. So in my opinion, guys, this is really too much. There is no point in this, really. Balanced approach, and of course best approach in my opinion is to have 1 leading indicator, okay, 1 lagging indicator, and 1 support resistant indicator, guys. Why? Because leading indicator will give you current trend momentum, okay? Leading indicator is current trend momentum. Lagging indicator, such as, let's say, MACD or awesome oscillator, which Chris prefers, is trend capturing indicator. So it can give you the trend which has already been captured. So you have momentum, you have trend, and you have one support resistance indicator, for example, pivot points, which can give you the cue where the price is heading. For entries, you can use entry indicators such as CCI, Stochastic, MACD. So the conclusion is, we use lagging indicator to confirm the trend. We use leading indicator to confirm an entry or immediate trend, or so-called momentum. We use entry indicator just to pinpoint an entry. We don't use Stochastic for giving us, I don't know, overbought signal if the price has really 20 pips to the upside. So imagine this, guys. So let's say that MACD has given us an entry here at this point, okay? For example, and indeed this is an entry point here. And now if you have Stochastic indicator, for example, on this part, and if Stochastic is showing you that at this price here, there is an overbought level, that would make you to exit the trade prematurely, okay? That is why for targets, you do not use Stochastic overbought, oversold. You use pivot points, okay? So that is why I'm saying always one leading indicator for momentum or immediate trend, one lagging indicator for overall trend, support resistance indicator just to give you the insight where the price is heading, and for a potential, of course, stop loss, and one indicator for an entry, for example, just to give you a quick entry. So that is good thing, and that all good systems are not clustered with a lot of indicators, okay? Now, what I wanted to talk about is basically the statistics which have been conducted, as I said, 4 or 5 years ago, and definitely they give you the insight how you can plot different indicators with different settings on different time frames, okay? By looking at this chart, by looking at this slide, basically we'll be talking now for euro-dollar SMA settings. 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour daily, and GBP dollar, same settings as for euro-dollar and same time frames. When we compare SMA settings, now of course guys, you can snapshot this, so you can practice and play with these indicators if you want. The best results were on SMA settings, were on daily time, were on 4 hour and daily time frame. This is loss, this is profit. So you just compare the settings. This survey of the indicators was conducted basically just by placing one indicator and trading from that particular indicator. There wasn't any filter which could have possibly filtered the trade. So the results are basically just from trading one simple indicator, be it a crossover or simply when the price is above or below the indicator. So simple indicator results. So you can see SMA for both euro-dollar and GBP, and you can see different results from euro-dollar and GBP, but most of the time the best results have been conducted on higher time frames, definitely 4 hours and daily, okay? Also, euro-dollar percentage of profit trades from long and short positions. Again, there were some profitable trades, of course, on every single time frame, but most of the time it was again 4 hour and daily. Okay? So the conclusion is 100 SMA works definitely the best on euro-dollar on 4 hour time frame, and 100 SMA on 4 hour time frame works the best on GBP dollar. Okay? So I don't want to crunch the numbers now and read through all these numbers, okay? But you just can snapshot this and take a look later. Moving averages or EMAs, now we are talking about exponential moving averages. Of course, There were some slight deviations from SMA, because if you take a look at SMA, look even on 5 minutes, 150 and 200, but on EMAs, there are also profitable trades on 15 minutes. Okay, so even 15 minutes were great, and on GBP, basically the setting on 150 exponential moving average did not produce any good results. Okay, so basically what we can say about this, Euro-dollar works better with EMA settings than it was GBP. GBP worked great on 200 and 100 EMA. Okay, Euro-dollar percentage of profit trades basically were the best again on 4-hour time frame and one daily on 50. So Euro-dollar had a best setting on 200 EMA on 30-minute time frame, while GBP dollar has the best settings on, it showed best results on 100 EMA on daily time frame. Of course, again, I say you can snapshot this, so you can take a look later and maybe create your own strategy, or at least it can help you to filter trades. Okay. Now, Euro-dollar results, so I am giving you the list of settings that produce positive results in the different time frame for both Euro-dollar results and GBP dollar results. Okay, 4-hour, 5, 10, 2, you can see 20, 50, 100, 150, 200 on 4-hour, and GBP results basically were best on 1 hour of all the SMAs, okay, and EMAs. So GBP definitely is favoring SMAs, while Euro-dollar is favoring EMAs. Okay, stochastic indicator. Okay, stochastic indicator definitely performed best on 4-hour time frame with 1435 settings. Okay, while in this study Euro-dollar was not profitable at all by just trading stochastic. Now guys, this is one of the examples why I say one indicator is definitely not enough. You cannot trade just stochastic crossovers or EMA, SMAs, crossovers or price crossovers. You need to have always additional filters to filter out bad trades. That is the logic of trading. That is how trading is done. So the best settings for definitely for stochastic on 4-hour time frame is 1435 with 80-20 levels, and while GBP was profitable enough, Euro-dollar was not profitable, but at least it is not a big loss because stochastic is used as a filter. It can be used as an entry, but then you need to have additional filters. Okay. Greg was asking what is the example of leading indicator. Leading indicator is CCI, leading indicator is stochastic. Leading indicator basically is the indicator which mirrors the price action. So many people argue with me about telling them that RSI is leading indicator. I think that RSI is also leading indicator because it is mirroring price action perfectly. Okay, so RSI, CCI, stochastic, those are leading indicators. Okay, and every single indicator which is basically custom indicator is just a reformed, revised version of existing indicator. Okay, so do not let marketeers sell you snake oil. Okay. This is also an example of GBP profitable trade on daily time frame by using 835 stochastic, and I have witnessed that really 835 stochastic setting is a good one, really. And you can see now 533 why we should not put our efforts on 533. It's really not a good performer. Again, higher time frames produced better results, with an exception of 1-hour time frame, which is a mid time frame, and basically produced good result on 1557 setting. This is again a crunching of numbers from the percentage of profitable trades. Okay, highest overall highest value, okay, with a reliable number of trades was again 1435 stochastic setting, definitely on both pairs, both euro dollar and both GBP. So 1435, 820 levels, okay, for both euro dollar and both GBP dollar, okay, for our time frame setting, okay. Then RSI, RSI being also a well-known indicator, and in my opinion, I say that is a leading indicator, okay. The thing is, yeah, this was done, I think, in the year of 2010, I think. But yet again, this study was conducted when there was also a volatility in the market. Okay, so the study was not conducted when there was no volatility. You can experiment with these numbers. I'm giving you the number crunch. I'm giving you the number crunch just if you want to play with these settings. You maybe want to create your own strategy, or you want to test something. You want to add something to your existing method or system. So you can use these studies to basically give you maybe a slightly better advantage, and I think it can help you. At least you can play out with these number crunches. Again, RSI indicator, look at this. Again, euro dollar, 1 hour, 10.50 was the best, but it produced a loss. While trading on daily time frame on GBP dollar was absolutely good on every setting instead on 10. So RSI gave the best results on 10, okay, 50 level cross, and basically daily time frame. 10 on 50 level cross, also on euro dollar. 32.27 trades were profitable on 10.50, and 14 80-20 settings on RSI were also profitable. Well, you can see that 10.50, in my opinion, gives best results. And again, guys, on higher time frame, at least for GBP, a euro dollar is RSI 10 on 1 hour, but you can see basically it ended up with a loss. But again, higher time frames are better performers if you take indicators into account. So definitely my conclusion is that indicators can be traded successfully, but overall it's better to trade indicator-based systems on higher time frames, okay? At least for these major pairs. So this is everything I have for you. If you have any questions, you can ask me. The summary of the webinar is definitely, guys, yes, I want just to show you dollar yen, the analysis, and I will give you a quick outlook of my Camera MACD. For momentum, I usually use MACD because MACD is capturing the trend. And yen, you can watch webinar about, Chris and I did a webinar about momentum. So for me it's MACD, which basically giving you the retracement and momentum capture. So that is my favorite. Chris likes, Chris actually prefers awesome oscillators. So awesome and MACD, they're good for capturing the momentum, but they give you also the overall trend. Also for momentum or current trend, yen and others, you can try with 12, 24 or 12, 36 exponential moving averages. Okay, so basically, guys, if you want to use any momentum indicators, I definitely suggest that you can use MACD, not momentum indicator, MACD indicator, and you can use lower EMAs, for example 12 or 5 EMA for giving you current trend momentum. Yen is asking what were those EMA for momentum. use 12 and use 5 EMA because those are fast-moving averages, and they give you current momentum. Okay. The link for momentum webinar, try to search for it. I don't have it now. It will take me some time to hunt for the link, so try to search it out. So my conclusion is, definitely guys, try to fix your I can say try to fix your attention definitely to one leading, one entry indicator, and just pivot points for pinpointing where the price can go. And also, if you want to take a chance by trading systems which are based on indicators, well, you just need to think about it in the terms of higher time frame trading, because from these studies we have conducted basically that, and we have concluded that indicators works best definitely on higher time frames, 4 hour and daily. Okay. Now, as for the analysis which I wanted to show you, this is the analysis which was made yesterday, and this pair was the best to trade, guys. This is where dollar yen was heavily bought 3-4 times after, and it made basically to the target today. So if you followed this analysis, you could have made 80 pips. Very simple: price action, trend lines, and confluence points. MACD is used for giving me momentum Q and divergence. That is all. Also, the question was about New Zealand dollar. Yes, I did the analysis on New Zealand dollar today. I will show you now. There is a possibility for a gap close. Yes, indeed. But now, guys, we need to wait for Asian session and Wellington session, because I am not trading. I actually scalped and tried to close the gap, and I got only 10 pips from long scalps. So I will not be trying to close the gap, but I would be shorting it for sure if it gets to POC later during the night or tomorrow. This looks like it should go lower, but now I don't know, because the gap hasn't been closed, if it will go straight from these levels, or it will close the gap then go down. Okay. Sign in, guys, for a session recap, please. I tweeted the link for session recap. I will give you the link right now down here on the chat window, because there was a mistake. Previous link probably is not working now, so this is the correct link. I personally scheduled it, so this should be a valid link. Okay, so just use this link. I have already tweeted it. So sign in for session recap. We had great trades last week, and I will be analyzing a lot of pairs. Okay, 5 pairs, and of course whatever you ask me to analyze on recap. One more question, then we need to close. For divergence, is there an indicator that draws it? Yes, yen, there is an indicator. I think it's called, what was the name of the indicator which draws lines? FX divergence or something like that. Try to Google for it, and I think it can be found. So yes, there is an indicator. I think that I also provided you with the indicator. I'm not sure that I have that indicator, but there is an indicator. I'm not sure how reliable the indicator is. You need to test it. I'm not sure. So we will talk about all of these things in our future webinars. Now just follow the analysis, follow the webinars. They are definitely of a good help to you. And sign up for live trading labs with Chris and weekly recaps with me. We are here to help you guys. I wish you really a good, relaxing weekend. Tomorrow there will be a vacation. We will be having a holiday, 1st of May, and actually most of the banks, a majority of the banks, will not work tomorrow. So relax, use the weekend for you, yourself, and your family, dear friends. And we will be here again with you soon, guys. Cheers and trade safe.